Welcome back, everybody, for another deep dive. This time we're taking a look at long-term investment strategies with a classic book.
Oh, yeah, a classic, Common Stocks and Uncommon Profits by Philip A. Fisher.
So this book has been around for a while.
It has, and still highly influential.
Absolutely.
Hmm?
And one of the things that I found really fascinating right off the bat was his use of these clues from the past to show just how much potential there is out there.
Well, yeah, you think about some of the companies, like the ones he mentions that have grown hundreds of times in value over the course of the 20th century.
Mind-boggling.
It is. But his point is that those sorts of opportunities are still out there.
Right. And it's not just about finding the next big thing either. It's about this shift that he talks about in corporate management towards long-term planning and R&D.
Yeah, I mean, that's a big one. That's something that he really emphasizes. Are companies really investing in their future?
So does that mean that those types of companies are automatically better investments?
Well, it's definitely something that he flags as something to look out for.
Okay. And he had some interesting things to say about bonds versus stocks,
Yeah.
particularly in inflationary environments.
He really challenges that traditional idea that bonds are always the safe bet.
Especially over the long term.
Right.
Because he says that inflation can really eat away at those returns.
Yeah, and he argues that stocks might actually be the more conservative choice in some cases.
It's a really interesting perspective.
Yeah.
And it kind of flies in the face of what a lot of people assume about investing.
Yeah, for sure.
So how do we actually put all this into practice? I mean, how do we find these uncommon profits? He keeps talking about.
That's where his famous 15 points come in.
Okay.
It's like a framework or checklist.
It's like a checklist for identifying companies
for long-term growth potential.
with strong long-term growth potential.
Okay.
But I'm guessing it's not as simple as just ticking off boxes.
No, you're right. It's about really understanding the principles behind those points and then using them to carefully analyze companies.
Right. So let's get into some specifics. He talks about Alcoa, the aluminum company of America.
Yeah.
And how they benefited hugely from the growth of the aluminum industry.
Yeah.
But they weren't actually the ones driving that growth.
Right. It was really external factors like the rise of air travel.
Oh, that's interesting.
That created this massive demand for aluminum.
Okay.
So Alcoa was in the right place at the right time. And they were able to really capitalize on that opportunity.
So you don't always have to invent the next big thing.
No, not at all.
Sometimes it's just about being aware of those larger trends.
Yeah, recognizing those powerful trends.
Okay. What other examples stood out to you?
Well, he talks about the Dow Chemical Company and their emphasis on both research and sales training.
Oh.
So they understood that even with amazing products.
You can't just assume they'll sell themselves.
You need to be able to sell them.
You still need that sales force.
Yeah, you need a skilled sales force.
So it's not just about innovation. It's also about execution.
It's about a holistic approach to business.
Got it. And then there's this story about Food Machinery Corporation. They started out very specialized, relying on basically a single product line.
A single seasonal product line.
So they struggled.
They did.
But then they started to diversify.
Yeah.
And that's when things really changed.
That's when they started to thrive.
Okay.
It's a great example of how diversification can be key
to long-term growth.
Yeah. Companies that can adapt and expand their offerings are much more likely to weather those inevitable storms.
Makes sense. So we're seeing some patterns here, writing those external trends, balancing innovation with sales, diversifying to reduce risk.
Yeah.
And then just to round out the examples, there's the case of Texas Instruments and their success in the semiconductor industry.
Oh, Texas Instruments. That's a great example of Fisher's emphasis on research and technological innovation.
Right.
They invested heavily in that, and it really paid off.
So they became a major player.
A dominant player.
In a really rapidly growing field, which is what Fisher tells us to look for.
That's right.
So those examples really bring the 15 points to life. But then Fisher also has this other tool that he calls scuttlebutt.
Ah, yes, scuttlebutt.
What is that?
Well, that's where his approach gets really interesting. It's about gathering firsthand information.
From lots of different sources.
Yeah, from customers, competitors, suppliers, and industry experts.
Wow.
So you can get a truly comprehensive picture
of the company. Okay. It sounds like investigative journalism. For investors.
It kind of is, going beyond those official reports.
And talking to people on the ground.
Yeah, talking to people in the trenches.
So did Fisher have any specific advice on how to use scuttlebutt effectively?
He believed that by asking the right questions and listening carefully.
You can learn a lot.
You could uncover insights that you wouldn't find anywhere else.
Okay.
Things like management quality, employee morale, even a company's reputation within its industry.
Those are crucial factors.
They are, and you can't always glean those from financial statements.
It's about understanding that human element.
Right, the culture, the dynamics that really drive a business's success.
It's detective work.
It is.
And it can be super valuable
Right.
for separating the truly great companies from the rest.
Absolutely.
Okay, so we've got these clues from the past. We've got 15 points to guide our analysis. And this secret weapon of scuttlebutt. It's like we're building a whole investor toolkit. But what happens when we find a stock that takes off? When's the right time to sell?
That's a great question. And that leads us to one of the most important aspects of Fisher's philosophy, knowing when to sell. And maybe even more importantly, when not to sell.
Okay.
It's about knowing when to hold them and knowing when to fold them.
So are you saying we shouldn't just jump ship as soon as the stock price starts going up?
That's exactly what he challenges, that kind of knee-jerk reaction.
It seems kind of counterintuitive.
It does. But his argument is that if you've really found a great company...
And long-term potential.
Yeah, with enduring growth potential, then holding on to it for the long haul can lead to much bigger returns than constantly trying to time the market.
Oh, wow.
Yeah.
So instead of freaking out about those short-term ups and downs, we should be thinking more about where's the company headed?
Exactly. The long-term prospects.
Okay.
He has this great analogy to illustrate this point.
Okay, I like analogies.
So imagine you had the chance to buy a contract with a former classmate
Okay.
who was clearly on track for massive future success.
Like they were going to be...
Like the next big CEO.
Okay.
Would you sell that contract just because it had already gone up in value?
Probably not.
Probably not.
You'd want to see how far they could go.
You want to ride that wave.
Ride the wave.
And the same logic applies to investing.
Okay.
If you believe in the company, don't let those short-term price swings shake your conviction.
Makes sense.
So patience is key.
Patience.
He talks a lot about that in the book.
He does.
He uses examples from his own experience.
Like with...
companies like Motorola and Texas Instruments.
Oh, yeah. Those are some big names.
Both of those companies saw incredible growth over decades.
But it wasn't always smooth sailing.
No, it wasn't always a smooth ride.
I remember reading about how Motorola had some trouble with their television business.
Yeah, that was dragging down their profitability.
But then they decided to sell it off.
They did.
And their stock price jumped.
It did. It's a classic example of how investor perception really drives stock prices.
So it wasn't just the earnings improving.
Right.
It was about the signal.
It was the signal it sent.
That management was being decisive.
Exactly. Taking action.
Focusing on the good stuff.
The more promising areas.
And the market loved it.
It did.
And that leads us to this other concept that Fisher challenges, the efficient market hypothesis.
Oh, the efficient market hypothesis.
Which basically says that the market is always right.
Yeah, all information is already baked in.
So no point in trying to find undervalued stocks because they don't exist.
Because the market's already figured it all out.
Sounds kind of discouraging.
It can be. But Fisher's point is that it's simply not true.
Right.
He believes that the market frequently misjudges situations.
So there are opportunities.
There are definitely opportunities.
For those who know where to look.
For astute investors to find those hidden gems.
So it's not about blindly following the crowd.
Right.
Or assuming that the current price
is always right.
It's about doing your own homework.
Yeah, doing your own research.
And maybe even going against the grain.
Sometimes you have to.
When you see something.
Yeah.
That the market's missing.
Exactly.
Okay, so we've talked a lot about the financial side of things. You know, analyzing trends, understanding those market dynamics.
Right.
But Fisher also mentions two additional dimensions that are really crucial for finding truly conservative, long-term investments, he calls them. The second and third dimensions.
Really, yes, the second and third dimensions.
What are those all about?
Well, the second dimension focuses on something that's often overlooked in traditional investment analysis.
Right. Yeah.
And that's a company's internal culture.
The culture.
The culture.
So it's not just about the numbers.
It's not just about the numbers. It's about finding companies that are not only financially sound, but also have strong leadership.
Okay.
A positive work environment.
Okay.
And a real commitment to developing their employees.
It's about the people.
It's about the people.
Okay.
And he highlights Motorola's Executive Institute,
Oh, yeah.
as a prime example of this,
Oh.
they invested heavily in training their employees
Right.
and developing their leadership skills.
So creating a pipeline.
Yeah, a pipeline of talent
That helped fuel their growth.
for years to come.
And it wasn't just Motorola. He also mentions Texas Instruments
He does.
and their People Effectiveness program, where they
Yeah.
really focused on empowering employees.
Yeah, encouraging collaboration,
Rewarding contributions.
leading to a more engaged and productive workforce.
So these examples show that a company's culture, their people, their commitment to fostering talent, it can be just as important as their financial performance.
Yeah, absolutely.
So it's about finding companies
Yeah.
that are investing in their people just as much as they're investing in
Their products or services.
their products and services.
Exactly.
Okay, and then there's this third dimension,
The third dimension.
which you said was about,
It's about a company's competitive landscape
so like their position in the market.
and how well they can defend that position.
So are we talking about brand recognition,
It could be the
patents,
patents, yeah.
proprietary technology?
Proprietary technology, definitely.
Okay, like that.
All those things can play a role,
Yeah.
but it's really about understanding what makes a company unique
Uh-huh.
and difficult to copy.
Okay.
So, for example, he talks about pharmaceutical companies
Okay.
that benefit from patent protection
Right.
and regulatory hurdles.
Which make it really hard
Yeah.
for new players to enter the market.
It's like a built-in defense system.
A moat,
A moat, exactly,
protecting their profit
from the competition.
from the competition.
So they can keep succeeding.
Even as the market evolves.
Okay.
He also talks about companies that have these unique technologies or
Yeah.
processes
Processes.
or distribution networks
To give them an edge.
that give them a real edge.
That's hard to replicate.
Very hard to replicate.
So these are the kinds of companies
Is
that
it?
can really
Stand the test of time.
stand the test of time.
Yeah.
So to recap, Fisher believes that truly great investments exhibit three key dimensions. We've got strong financials,
Right.
a thriving internal culture,
Yes.
and a durable competitive advantage.
Yeah, those are the three pillars.
So it's not just about being good at one thing, it's about being firing on all cylinders.
Exactly.
And this all ties back to Fisher's belief that investor perceptions are really what drives stock prices.
Yeah, he makes a compelling argument
Mhm.
that every significant price move,
Relative to the market, is driven by a change in how investors,
the financial community.
the financial community, see that stock
So even if a company is doing well,
performing well.
the stock price could still go down
Absolutely.
if investors are feeling pessimistic.
If they're worried about the future.
It's like psychology matters.
It does, at least as much as the actual number.
And on the flip side,
Yeah.
a company that's struggling,
Could see its stock price go up.
if investors think those struggles are temporary.
If they believe in the long-term potential.
So it's not always what it seems.
It's not always about the immediate situation. It's about the bigger picture.
Okay.
And Fisher's point is that by understanding how that sentiment can shift,
Yeah.
we can make better decisions.
Avoid those mistakes.
Like selling too early.
Or chasing after a hot stock.
That might be overvalued.
It's about being disciplined,
It is.
doing your own research,
Yeah.
focusing on the fundamentals.
Not getting swept up in the hype.
So to wrap up our deep dive into common stocks and uncommon profits, what are some of the key takeaways?
Well, we've learned that prioritizing long-term growth is essential.
Okay.
We need to really dig deep into companies, using those 15 points
As a guide.
as a guide, and gather those additional insights using Scuttlebutt.
All right, talking to people.
Exactly. And we need to remember to look for those companies with those competitive advantages,
Those moats.
the moats that protect them.
And most importantly,
We need to be patient.
patience.
Don't get swayed by the short-term whims of the market,
Think like an owner.
not just a trader.
Exactly.
And Fisher leaves us with a thought-provoking question.
Yay.
He challenges us to consider which companies or industries are currently being overlooked.
Or dismissed.
Yeah, dismissed by the market, but might actually hold that potential for long-term growth.
The hidden gems.
The hidden gems.
So it's an invitation to think differently
To challenge conventional wisdom.
and trust our own analysis. Well, this has been fantastic. Thank you so much for sharing your insights with me.
It's been my pleasure.
For more such content, go to our channel, Pages and Perspectives. Don't forget to like, share, and subscribe, and press the bell icon to get the latest updates. Thank you for joining us.